If you're trying to trade using support and resistance, or you're thinking about trading with support and resistance, then I want to warn you that these concepts have some flaws that can make it very difficult to win. But there's a similar and more effective alternative that you can use to get better trading performance, all of which I'm going to break down today. Now, if you're already trading with support and resistance and you're profitable in doing so, then keep doing it. I like to say there is no right or wrong when it comes to technical analysis. There are hundreds of different ways to make the same returns. But due to the weaknesses that I'm about to cover, it is difficult to win with support and resistance, and most traders can't make it work. So if you're a trader who's using it and is struggling to win, or you're thinking about using it, then the alternative that I'm going to show you today might just be that game changer that you need to start getting positive results. With that said, let's get to the learning. Support and resistance looks just like this. A support floor is an invisible level that price bounces off multiple times, and the concept is to buy support. A resistance is the same, an invisible level that caps price, and the concept here is to sell from resistance. Now, the biggest thing that stops support and resistance from consistently working is liquidity. And to give you a brief rundown of what liquidity is, liquidity simply refers to orders, and markets react purely to orders. When a market goes up, it's because there's more buying orders than selling orders in a market. And when the market goes down, it's because there's more selling orders than buying orders. Now, in the context of support and resistance, above a resistance level, we are going to have a lot of orders. This is because traders who sell resistance will put their stop losses above this level. As well as that, a common way to trade support and resistance is to wait for a breakout and then look to buy once the market comes back. So we are also going to have buying orders up here as well in the terms of market executions when the market gets there, or buy stop orders that will automatically trigger traders into buy trades once that resistance is broken. So because support and resistance is such a common concept, there is a lot of liquidity and a lot of orders forming around pretty much every support and resistance level that we see in a market. This huge collection of orders then acts as liquidity and kind of as a magnet for price. It's likely that price will trade into these orders, but with all the buys being executed here, in terms of buy stops and the stop losses from the sellers, we very often will see markets reverse, because this new collection of orders allows the market to change direction. A huge amount of selling can be placed on in conflict to all of the buying that's now taking place here, and we can see the market pushed down. Which means if you were selling resistance, you would be stopped out and you would lose the trade. The exact same concept goes for support as well. We formulate a lot of liquidity around a support floor, which means that we are pretty much just as likely to get that liquidation, meaning buying from support or selling from resistance becomes very dangerous because the areas below support and above resistance act as magnet areas for price. If you want a deeper and more detailed explanation of liquidity, there's a card somewhere at the top of the video. Click that and watch that video. It's one of the best ones you'll see on liquidity on YouTube. But the key takeaway that you need to know is that markets react to orders. They are going to react to buy orders and sell orders, which means in the middle of a range, for example here, there's not going to be a lot of reactions taking place because all of the orders are waiting at highs and lows. Where do people buy? Support. Where do people sell? Resistance. Where do they put their stops? Below the low or above the high. Where do people look for breakout trades? Above a high or below a low? Within the range here, there's no real orders. So the market can move freely through ranges, and it's only once we start to liquidate highs and lows, for example, take out the stops of support buyers and resistance sellers, that the market is going to be due for reversals. So for that reason, it becomes a very tricky and risky concept to trade with, and the win rates really aren't that high. As well as that, there's just not really a whole lot of logic behind support and resistance levels. It's an invisible line, it doesn't exist in reality, it's just something that you've drawn on the chart. And yes, the market's reacted from it a couple of times, but that's kind of as a self-fulfilling prophecy of small amounts of buying taking place at support, small amounts of selling taking place at resistance. We know that there's no significant institutional buying or selling taking place because generally around a support or resistance, we're going to form ranges and we struggle to actually make meaningful movements. If you go and look at the charts, and we'll show some examples in a bit, you're very often going to see that the real large movements happen after a support or a resistance has been swept, meaning if you were buying support, you would be stopped out before the true move occurs. Now, the alternative that I'm going to show you today is going to allow you to take advantage of these movements and of these liquidations so that you can be the trader who's getting in here instead of getting stopped out here. And then instead of having to watch this movement in pain while you're not actually profiting from the movement, you will be in and ready to take advantage of the larger institutional moves. The alternative concept that I wanted to present to you today is supply and demand. Supply and demand is somewhat similar to support and resistance, as it's just areas that we're waiting for the market to return to in order to make our buys or sells. So for reference, demand zones look like this, and they formulate at the bottom of large pro-trend movements. Supply zones look like this. So they are pretty much exactly the same, but they are in a market that is selling. So supply zones are for selling trades and demand zones are for buying trades. Now, the reason that supply and demand can be more effective than support and resistance is because it is grounded in logic. Now, when we look at a support or resistance, we are simply identifying an invisible level that price has made some minor bounces from a few times. But when we look at supply and demand, we are looking at key price areas where significant buying has taken place. So if we take a look at this example, we would have a break of structure just here, which indicates the market is moving in an uptrend. You can see by the fact we are forming higher highs and higher lows, the market is uptrending. Now, when the market is able to break into a new high, such as with this movement here, that validates that a lot of buying took place at the low of this move. Because as we said, why do markets move? Well, when there's a significant amount of buying, the market is going to move up, which tells us if the market moved up enough to make a new high in a trend, then a significant amount of buying and a significant amount of transactions took place down here in the low. So why is that important to us moving forward? Well, now we have an area where a huge amount of buying took place, and then we have a free range that the market was just able to run through because there was no level of significant orders anywhere within this range. So if we think about what charts are actually showing us, which is price, demand zones are presenting to us price levels that people were happy to buy at. So from this example, we can see that between 1.12 and 1.119, lots of people, including institutions, because they are the people who drive the market, so commercial banks and trading firms, they were happy to pay this price between 1.119 and 1.12 for this asset, which tells us this is seen as a discount price or a good price to buy at. Now, you can think of this like real estate. When there's huge demand in the housing market, housing prices go to the absolute moon. They go incredibly high, and then eventually something happens. People can't afford to pay these prices for houses. People start buying, and house prices come back down until people are happy to pay that price again before we make another move up. Now, the same is true in financial markets here. As with any market in the world, we saw traders and institutions happy to pay at this price for this asset. They're not happy to pay up here, so then the market rides back down, facing pretty much no resistance from orders or transactions. And then when we reach this area, which was previously seen as a good price to buy the asset, we get another push away again. And with each pro-trend movement that we see, such as with this new break of structure, we would formulate a new demand zone. And that demand zone is generally going to be down here in the low, but will sometimes be higher up. And we'll discuss that a little bit later. Now, what we aim to do is just follow the trend. And once the market pulls back to these areas, we are looking to continue the phases of buying. And if we were in a selling market, we would just be following supply, because what is this showing us? Areas that people see as a great price to sell. Whether that is short selling with the plan to buy back later at a lower price, taking profits, or just exiting the market due to how high up it has got. So to plot a support and resistance level, all we look to do is find an area where the market has touched a level multiple times, and then we use that as our support or resistance. So we can see we had this high, and after breaking above this high, we use this as support 1, 2, 3 times. So the concept here is now to buy support and actually look to take the market to new highs with a stop loss below this low. So that formulates kind of problem number 1. We know there's going to be a lot of orders and liquidity below this level. Now, in order to plot a supply or demand zone, we are looking for price areas before pro-trend movements. So just here you can see this area pushed and broke above this high. Then we came down, this area pushed and broke above the previous high. So this would be a demand zone, this would be a demand zone, this would be a demand zone too. Now this is the one that has currently broken the structure that we're looking at. So we could look at marking out this demand zone here, and to mark a demand, we just look for the consolidation area just before a large up move. So you can see here, this is consolidation, there's the up move, there's the break of structure. That shows us that this demand is actually an area where a lot of buying took place previously. So now we have a demand zone and we have a support level marked on the chart. Now the concept for support is obviously to buy from support. The concept for demand is to buy from demand. Now, remembering what we said about the liquidity problem, there is going to be a considerable amount of orders in this region. And we also know this was a high interest area for buying previously. So there's a chance that if we trade into here again, we will once again start to buy. And there's also chance, because of the liquidity, that we are likely to push through this level before we buy. So now, if you were a support buyer, your trade may be something like this. And if you were looking to buy from demand, your trade would look something a little bit more like this. So now let's play the market through and see what actually happens. Now, as you can see, the market has taken out the buyer who bought from support, but actually falls in line with the trade of the buyer who bought from demand. Now, let me just mention as well, you don't have to use buy limits to get into these trades if this seemed a little bit unsafe to you. Instead, what you can do is wait for the trend to move in your favor, and then you can use one of these demand zones, for example, this area or this smaller area here, and you can execute your trade from there because now the trade agrees with you. So the real demand zone traders trade would look more so something like this, where we have a slightly later but considerably safer entry, and we're not relying on just hoping that level holds up. So now let's take a look at that difference between support and resistance and supply and demand. Now the support doesn't really have too much logic to it, except for this is a level the market's reacted from, so it should do it again. There's no consideration of where people were buying previously in mass. If we take a look at this level, we didn't really have significant pushes away, enough to make new highs from this level. Instead, the movements we did get are kind of these small moves where the volume is not too strong, because there's no significant institutional buying, which is the buying that drives the market, until we reach these demand areas. When we trade to this demand area, which indicated by this huge move is an area that people bought previously in mass, then the market actually has a meaningful reaction and starts to push into new highs. Now, this isn't the only example you're going to see within this trending movement. If we look just after we broke this new high here, this would be a resistance turn support. So now support buyers would be looking to buy with stops under the lows. So support trades could look just like this. Now, if we go back to the concept of supply and demand, where would the demand zone be here? Well, it would be within this accumulation before the movement that broke the trend. And there'd also be clear demand down here, which we could expect the market to come into at some point in the future. So demand buys would look for that same pattern that we looked for from these areas, as opposed to just directly buying from support, hoping that this holds up. And once again, with that liquidity, what can we see? Well, this is mid-range. This support floor is taking place in the middle of a range. There's not going to be a whole lot of orders here. The orders are waiting in these higher volume areas where people have bought in mass previously. So areas like this one and this one. And now if we let this trade play out, you'll see even these small areas are prone to that liquidation. And the true move, enough to actually push towards the highs again, came from a retest of demand, not from the support or any resistance levels. The support once again tricks people into buying by looking like it's going to work, but because it's mid-range, there's just not a significant number of orders there in order to push the market higher. So those traders that buy there lose, which leads into the winning trades for the demand buyers, even on a smaller, more scaled in perspective. And once again, what can we see happening here? Well, we've now formed a new level of support. We had support here, support there, then we broke, acted as resistance, then we came back up, we broke, and now we've acted as support, support. So now there are once again going to be a new wave of support buyers looking to buy from this low with stops there. So they may have buy orders like this, or they may even be executing trades in the current range, expecting that the market will not go below this low again. But what do we know? Well, at the low of this range here, this larger movement was an area where a huge amount of buying took place, indicated by this bullish candle, leading into a new high and a new break of structure in the pro-trend movement. If we once again consider what the support and resistance has achieved, we've never really made a new high from a support retest. So here, this is retest 1, which we wouldn't really consider. Retest 2, which is where people start buying. There's no significant movement. Until we retest demand, then we push away from demand. Now that we've had a second retest on this support, we still don't have the strength to push into new highs. And instead, those support buyers are once again stopped out. And where are we going to be looking to buy from if we are using supply and demand instead? Well, we will be looking to buy from this demand zone, and we can have targets up into the highs because we know this is likely to lead through into a pro-trending movement. And when we see the market come into demand, you see immediately we get a big push of buying because this is seen as a discount price for buys. See how strong the market reacted from that demand level because we had a clear indication that buyers are now taking control. We have a clear area. We know that buyers are going to be getting involved. And after the buying area is hit, we get a huge drive to the upside, which drives the trade in the right direction. And guys, in the very same example that I just showed you, you'll see that even the counter trade trends work better as supply or demand. Now, I don't particularly suggest trying to trade counter trend all the time because it's going to lead to risk and losses. But you can see we have a resistance here And some people will sell this resistance. They see the two taps, they think that's a double top, I'm going to sell the market. So we know there's liquidity above there. And what you're going to see happen is the market actually drives through that liquidity. Then we get this push, which breaks some of the internal structure. And what do we form? A supply zone. The supply zone is this here, which is the consolidation before the big down move. Now, if you were to sell from this supply, and as I say, counter trend trades like this aren't always the best thing to do. You can see that even in this scenario, which is not going to be an A plus setup, it still favors the supply and the demand over the support and resistance. That resistance level was liquidated. Anyone selling there is going to lose. However, the supply zone reacts nicely and then drives the market through to a new demand, which is where we got that new buying trade opportunity after we made this new high. So as you can see from the examples we've looked at, support and resistance is usually less effective than supply and demand. There's a few flaws with support and resistance, one in which being it's not very logic based and all we are doing is drawing lines on the chart that don't really exist in reality and looking for reactions from them. With supply and demand, we're looking for high volume areas where buying has taken place en masse previously, indicated by new breaks in the trend and new highs or new lows if you're looking on the sell side. Another flaw of support and resistance is that it pretty much forms everywhere, which means a lot of the time it will be mid-range. We know transactions and orders are taking place at swing highs and swing lows, not in the middle of ranges. So if we see a support or resistance level form in the middle of a larger range, it's rather unlikely that the market will actually react from there well enough to give us a meaningful position. Whereas when we're looking at supply and demand, we are looking at significant reactions from swing highs and swing lows. Now, before we finish, I want to give you a direct system that you can start to use in order to trade supply and demand. I've obviously introduced the concepts to you in this video, and you've seen some small examples there, but there's a simple formula that you can follow to get good results consistently by just following one supply and demand setup. So let's go over and look at that now. So the first step is to identify the trend direction. So if we were looking at this market, we would see that this market is moving to the upside. So we have higher highs, indicated by breaks of structure, which tells us that the market is trending to the upside. The next step is to find an imbalanced supply or demand zone. Now, an imbalance, also known as a market inefficiency, is basically an area between where price is now and a demand zone or supply zone that hasn't yet been retested. So in this example, we could see the demand zone here has been retested, but we have a demand zone here which kicked off this larger move, and this hasn't been retested yet. And then what we would do is place our buy orders here with a stop loss under the demand zone, and then when the market returns to this level, we could actually see the market continue through into new highs and provide us with a winning trade. So we would be looking for the market to do this, and then we would have our continuation opportunity. And we can do the exact same thing with selling opportunities. So we identify a downtrend indicated by breaks of structure that are continually forming new lower lows and lower highs. And when we see a market that is forming these lower lows and lower highs, we look for an imbalanced supply zone. In this example, we could look at an opportunity like this. And when the market pulls into this region, we would simply sell with a stop loss above the supply and look to take it down to new lows. Now, in terms of finding targets for these positions, you can just target the recent low, or if you were in a buying scenario, you could target the next high. So this way, we have a very simple trade, and all we're looking for is for the market to trade back into the high, and that will lock in our trade for a profit. Now, when we do this, we are obviously playing a positive risk-reward game, because when we buy from demand, we have the entire range to the upside as a target, and our stop loss is just below the zone. So our target is always going to be 2, 3, or 4 times bigger than our stop loss. Meaning if we lose this trade, let's say we lose $100, but if we win this trade, we would actually win $487. And this risk-reward discrepancy, where you make more when you win than you lose when you lose, is where money is actually made in trading. So here's an example of a simple supply zone selling setup. Here we have a market that is downtrending, as indicated by the continuous formation of lower lows and lower highs. So if we look at the larger trend, we have the move here, come down, lower low, lower high, lower low, lower high, lower low. Okay? Now looking inside of this trend, we can see that pretty much every supply zone that has formed so far has been retested. So this is the supply at the top of the move that has been retested. The markets then come up, and before we formed this new low, we left another supply zone. So this supply zone here has actually not been retested yet, as you can see. Another interesting thing to note, considering we're on the topic of support and resistance, is we have a support here. What does that tell us? Well, that tells us that there's going to be liquidity above this level. So we know there's liquidity acting as a magnet for price, and there's an open supply zone which is likely to be traded into. Now, in the nature of simplicity, we are using the lows as targets for selling moves. So we would place our order here, our stop loss would go above the zone, and then the target for this trade would be down at this low. And that would return us 2.96% for every 1% we risk. So if we risked $1,000 on this trade, we would make $2,960 if it wins. Likewise, if we risked $10, we'd be looking at making $29.6 on a win. And as you can see, the market trades up into that supply, sweeps that liquidity, takes out the sellers from resistance, just as an extra little note. We get the trade and it runs down to our target. So what we're looking to do here is very simple. We are just looking for the high probability supply or demand zones, which is why we look for that imbalance or open price that we spoke about previously. And then we are placing our orders in line with the trend, just looking for a simple movement to actually continue the current trend direction, which in this case is bearish. So we would just look for a bearish move to trade down towards this low. And by the way, guys, this trade is on the daily time frame. So I'm showing you this because this strategy of supply and demand works on absolutely every time frame. You can do this on the 5 minute if you want to. You can do it on the hourly, the 4 hour, you can do it on the daily. It does not matter. And here would be another example, this time on the buy side, and this is on the 5 minute time frame, just to highlight that you can do this same thing on the high and the low time frames. So here we can see the market shifted into buying at this level. We had a higher high, higher low, higher high, and we can see we now have two demand zones. We got a demand zone just here, but we've also got this demand zone that's imbalanced. And this is why I highlight the importance of looking for imbalanced zones. Now, previous to this, these demand zones have all been retested, as have these. So we could use this as our target for our entry to a trade. So we would buy on this level, our stop would go below this zone, and our target would be just to the high. That's the nice, simple, effective way to do it. Now, if this trade wins, we win 3.47%. If it loses, we lose 1%. So we have that positive kind of risk-reward outcome in our favor as well, which is, of course, as I said, how we make money long-term by kind of balancing to make sure we win more when we win than we lose when we lose. So this trade took some time to get filled, but as you can see, that simple formula of just entering from imbalanced demand zones, targeting the high in the trend or the low on a sell side trade is going to provide you with opportunities that will consistently bring you money. Now, this system can be effective enough to build you consistent profits month after month, but it's not optimized. It's probably only going to win 3, 4, or 5 times out of 10. And although the risk reward discrepancy there will make this profitable for you, there are better ways that you can use supply and demand in more refined, more optimized strategies to get bigger returns and higher win rates. Now, if you want to learn how to do that, I have a 5-day bootcamp coming up very soon. There's no crazy £1,000, $1,000 price tag on it, so it's wildly accessible. And within it, I will teach you a full strategy that you can use, teach you about the intricacies of structure, supply and demand, liquidity, and all of these different concepts that I use to take trades like this and this last week. And my students are using to consistently make big money in the markets and get a lot of funding as well. So if that sounds interesting to you, check out the link at the top of the description. You get my full course and you can join us for the bootcamp. And if you're still here now at the end of the video, I want to thank you for sticking around. Please drop a like if you've enjoyed the video. That helps me out. And make sure you subscribe because I post these videos every single week, usually twice, to help you improve your trading. So thank you for watching. I'll see you in the next video.